You do not need $10,000 to start investing in ETFs. You do not need to understand every company on the ASX, and you definitely do not need to wait until you feel like an investing expert. If you have $500, a tax file number, and a basic brokerage account, you can understand the whole process in 5 steps. But the dangerous part is not buying the ETF. The dangerous part is buying something you do not understand through an account structure you did not check with fees you never noticed. So, here are the 5 steps to buying your first ETF in Australia, starting from absolute zero. Number 1. Check that this money can stay invested. Before you pick an ETF, before you open a broker app, before you search for VAS or VGS, start with one question. Can this $500 stay invested? Because ETFs can fall in value. MoneySmart lists market risk as one of the key risks of ETFs. If the market or sector the ETF tracks falls, the value of your ETF can fall too. That is why ETF money should usually be money you do not need for short-term bills. Think of it like planting a fruit tree. You do not plant it on Monday and yell at it on Friday because there are no mangoes. Investing is slower than that. For example, Vanguard lists both VAS and VGS as high to very high risk, with a suggested investment timeframe of 7 years or more. That does not mean everyone must hold those exact ETFs for 7 years, and it definitely does not mean they are right for everyone. It means share market ETFs are not designed for money you might need next month. You're probably thinking, but I only have $500. Does that even matter? Yes. Because the first $500 is not just about the amount. It is about building the habit without blowing yourself up. What this means for you. Before buying your first ETF, decide whether this is truly long-term money. Step 1 is not exciting, but it stops you from turning investing into panic selling. Now that the money has a job, step 2 is choosing where that money actually sits. Number 2, choose the brokerage account. An ETF is bought through a broker. Plain English, a broker is the shop front. The ASX is the marketplace, and the ETF is the item on the shelf. MoneySmart says you can buy and sell units in ETFs through a stockbroker, the same way you buy and sell shares. When you open a brokerage account, you will usually need basic ID details: name, address, date of birth, bank account, and your tax file number. The tax file number matters because ETFs can pay distributions, and those distributions may need to be reported at tax time. Now, there are 2 account structures beginners often see: CHESS-sponsored and custodial. Do not stress. Here is the coffee version. With a CHESS-sponsored broker, you usually get a HIN, a holder identification number. MoneySmart says a HIN is issued by the ASX when you become a client of a broker, and shares bought through that broker are connected to your HIN. With an omnibus or custodial setup, your investment may be held through another structure. MoneySmart notes that some entities use an omnibus HIN to hold shares, which can mean investors are not the legal owner and may have fewer protections if something goes wrong. This does not mean every custodial platform is bad. It means you should know which structure you are using before you put money in. You're probably thinking, which broker should I use? This is where personal circumstances matter. Some people care about low brokerage, some care about CHESS sponsorship, some care about automatic investing, some care about a clean app that stops them from making mistakes. This is general education, not personal advice. So the point is not, use this broker. The point is, do not choose a broker only because the app looks pretty. Check the fees. Check the ownership structure. Check the minimum investment rules. What this means for you. The broker is not just an app. It decides your fees, your account structure, and how your ETF is held. Step 2 gives you the shop front. Step 3 is choosing what you actually buy. Number 3, pick the ETF before you press buy. An ETF is not a single company. It is a fund that trades on an exchange. MoneySmart explains that an ETF is a managed fund you can buy or sell on an exchange, like the ASX or CBOE Australia. When you buy an ETF, you own units in the ETF. You do not directly own every company inside it. That matters, because if you buy one ETF, you might be buying exposure to hundreds or even thousands of investments. For example, VAS is an Australian shares ETF that gives exposure to the top 300 companies listed on the ASX. VGS is an international shares ETF that tracks developed market shares outside Australia, and Vanguard lists its management fee at 0.18% per year. VAS currently lists a management fee of 0.07% per year. Now pause there. This is not me saying buy VAS. This is not me saying buy VGS. They are just examples because Australian beginners search for them all the time. The real lesson is how to read any ETF before buying it. Ask 5 simple questions. What does it invest in? Is it Australian shares, international shares, bonds, property, gold, crypto, or something more complex? How much does it cost each year? Does it track an index? Is it physically backed or synthetic? And what does the PDS say? A PDS, product disclosure statement, tells you what the ETF aims to track, its fees and costs, how to buy or sell it, and the risks. Think of an ETF like a smoothie. The ticker is just the label on the cup. The holdings are the ingredients. You do not buy the smoothie just because the cup looks nice. You check what is inside. What this means for you: do not start with, what ETF is popular? Start with, what does this ETF actually hold, and do I understand the risk? Step 3 picks the ETF. Step 4 is the moment beginners get nervous, placing the order. Number 4, place the order without overcomplicating it. This is the part that feels scary the first time, but mechanically it is simple. You log into your broker, you search the ETF ticker, for example, VAS or VGS. You check the name matches the ETF you researched. Then you choose how much you want to buy. Here is where the $500 title comes in. Many brokers have a minimum investment amount for a first purchase. In a beginner guide hosted by ASX, CommSec gives $500 as the initial purchase amount for a stock, commonly called a minimum marketable parcel. That is why $500 is a clean beginner number. Not because $500 is magic, but because it often gets you over the first purchase hurdle on many Australian brokerage platforms. Let's say the ETF is trading at $100 per unit. With $500 before brokerage, that would buy around 5 units. If the ETF is trading at $125 per unit, $500 would buy around 4 units. Then you choose the order type. Beginners usually see 2 words: market order, limit order. A market order says, buy now at the available market price. A limit order says, only buy at this price or better. For a beginner, the important thing is not sounding clever. The important thing is avoiding surprises. MoneySmart says the price of an ETF should usually be close to its net asset value per unit, but at times, the price can move away from the ETF's underlying value. MoneySmart also says that to get a price more likely to represent the underlying value, place ETF trades at least 30 minutes after the market opens. So the first trade does not need to be dramatic. Do not rush at market open. Do not smash buttons. Do not buy the wrong ticker because 2 names look similar. Check the ETF code. Check the unit number. Check the estimated cost. Check the brokerage. Then review the order. What this means for you: buying an ETF is not the hard part. The hard part is slowing down enough to check that the order matches your plan. Step 4 gets the ETF into your account. Step 5 is what happens after, because buying is only the start. Number 5, set up the boring aftercare. Once the order goes through, you are not done. You are now an investor. Tiny bit fancy, but mostly paperwork. MoneySmart says ETF trades settle 2 business days after you buy or sell. Your broker will show the holding in your account. If you are CHESS sponsored, you may also receive CHESS holding statements. Then, over time, many ETFs may pay distributions. That is when the ETF passes through income like dividends, interest, foreign income, capital gains, or franking credits. ATO says if your ETF invests in companies that have already paid tax in Australia, you may be able to claim franking credits, and your statements will show those credits. This is where beginners get caught. They think, I didn't sell anything, so there is no tax. Not always. ETF distributions can still matter at tax time, even if you reinvest the money. So after you buy, keep 3 things organized: your buy confirmation, your annual tax statement, and your cost-based records. That sounds boring. Good. Boring is underrated. Because the goal is not to buy your first ETF and then stare at it every hour. The goal is to build a repeatable system. Maybe you invest monthly, maybe quarterly, maybe only when you have spare cash. But the system matters more than the first trade. Here is the full 5-step loop. First, check the money can stay invested. Second, choose the broker. Third, understand the ETF. Fourth, place the order carefully. Fifth, keep the records and manage the tax side. That is the whole process. Not mysterious, not only for rich people, not something you need to overcomplicate. And that closes the loop. With $500, you are probably not buying financial freedom overnight, but you are buying something more important: your first rep. The first time you go from confused to capable. The first time the ASX stops feeling like a casino screen and starts feeling like a tool. That is what the first ETF purchase is really about. Not becoming rich this week, becoming the kind of person who knows how to start.